Then accrued and other liability. Again, these liabilities would be primarily be or maybe your expenses which are waiting to be paid or something. So again, as I did for prepayment, I can apply the same logic here as well. Or you can go to the back notes and you can find out what is there in the accruals and you can forecast it each one separately. So there are both the ways can be used. So here I do not find it up to be a major element. That's why I do not put in the effort of going back and going into the notes and finding out what are the individual elements and then forecast each one separately. So simply what I have done is that I applied the same logic which I did for prepayment, and so I took it as a percentage of SG&A, and when I took it as a percentage of SG&A, I found out that percentage is almost stable. So then I attached it in future as well. If you find out difference, if you find out significant difference in the percentage, like for example 15, 20, 22, 24, then that would mean that this is not an ideal way to forecast. Then you will have to think of something else. But here the trend is very obvious. So you know that it moves with the SG&A. So you have forecasted it as a percentage of SG&A. So you get the forecasted percent, you get the actual percentage, calculate actual percentage. Based on that, you forecast percentage. Based on percentage forecast, you calculate the amount. Any confusion up till now? Current liabilities held for sale, just like current liabilities for held for asset, you just stretch it. Debt due within 1 year. So assuming that any debt which becomes due will be paid, any additional debt which is taken will be paid. So it also remains same.
Current liabilities held for sale.
Sorry, current liabilities held for sale. Yes. So maybe you have an instrument or you have a payable, or maybe you have maybe you have made some loss on some contract or some derivative contract or some maybe financial asset which you have to pay for, and if you have to pay which you have to pay for, and if you then transfer that liability to another bank, or if you enter into a contract with a bank through which you transfer it to another party, or you transfer it to bank, that is get some money and sell it to bank, then that would become your liability held for sale. So any liability which you have which you wouldn't be paying by yourself but you are planning to sell it, that can be current liability held for sale. That is the general idea. Otherwise what you can do is find out the accurate. Okay, so this is that they have divested a business, and as they have divested a business, there are certain liabilities which have to be sold to that particular buyer, and so they are held for sale. So there are some asset also held for sale with respect to that particular brand, and there are some liabilities held for sale as well. So it would be in this business, and it would be in other multiple businesses as well. And when you combine all of those, then that would become current held for.
Normally we turn it to zero.
If you turn it into zero, you can do that, but then you will have to take an impact into income statement because it is currently held for sale. So, and secondly, you do not know how much would the income be. Why? Because you do not have the baseline value. For you to calculate income, you need to have the baseline value, that what was the previous value of this asset and now at what price is it actually being sold, or at what price will it actually be sold. So yes, either you can do it that you can take it as zero. So take it as maybe what it is. Yeah. So either you can do it that if you know that in this year it will be sold or transferred, take it as zero here. But when you take it as zero here, then take an inflow in the cash flow statement. And then the assumption would be there is no income loss. Why? Because it was sold or it was transferred at the same value as it had on balance sheet. So you will take it as cash inflow on cash flow statement. And similarly for current liabilities held for sale, turn it to zero as well, and take it as cash outflow in the cash flow statement. So take both as, so if when you transfer and if you are giving it an asset, if you are reducing your asset, then your cash will increase. If you are reducing your liability, your cash will decrease. So you can decrease it, take it as zero, and if you take both of these at zero, then take its impact in cash flow statement. That can also be done, but that again wouldn't have any significant impact on value because amount is very low. But yes, you can turn it to zero, take it as zero, and then get it off. Otherwise, it is better to stretch it because the assumption is that if you look into it, in 2015, it also had some current liabilities held for sale. Before that, it also had some current liabilities held for sale. So it means that at the end of each year, there is something on which it has to pay something or receive something. Otherwise, you can convert it into cash if you want. That would be similar. Okay, debt due within 1 year, taken with the assumption until and unless you have a loan amortization structure and you can make it, then you want to make it and you have it in balance sheet or annual report given, then you can make the structure. Otherwise, we take it as constant with the assumption that that will remain be the same. If that level is going down, then you will borrow more debt. So your debt level will stay be the same. So long-term debt taken as constant, unless in cash flow you come to know that you need additional debt for capex, you take it as constant. Deferred income tax, as we discussed earlier, take it as constant on liability and asset side both. Why? Because we have forecasted tax at effective rate. So we are assuming whatever the tax would be paid during the year. Non-current, nothing unusual item. Other non-current liabilities. So you can either go into it and forecast each separately, or if it is not significant, then just forecast it as it is. Key levers on balance sheet change are what are in control of management, like inventory days, debtor days, payable days. You cannot just stretch it as it is. Why? Because as business grow, debtors will continue to increase. So you cannot have a constant debtor. You cannot have a constant payables. Why? Because as business grow, you will be have to make more payments and payables will continue to grow. As business grow, you will need more inventory and inventory will continue to grow. That and fixed asset, obviously, because fixed asset would tell you the capex, and you need to know about the capex to perform your valuation. Long-term deferred tax, non-current, and this will give you total liabilities. Going down, equity, assuming no additional shares are issued, no shares are bought back, remains constant. Common stock remains constant, assuming there is no buying or no selling. Additional paid in capital stays constant, no new capital being raised. Reserve for ESOP, that requirement. ESOP is employee options, employee stock ownership plan, in which employees are given a plan or given an option to buy company's shares in future. So its value may change based on the change in value or based on the change in employers. If some employees have exercised it, it can go down. So this reserve is being kept for it. So we have just stretched it as it is. Accumulated other comprehensive income. So again, as I know that what are the items going in other comprehensive income? Unrealized gains or losses, and actuarial gains and losses. So first of all, we do not, when we are doing forecasting, we are not usually forecasting foreign exchange. So until and unless we know some gain is coming our way, we do not forecast it. Why? Because once it gets realized, it will in any way hit PNL, and we have forecasted PNL, so we know what will be realized. So that's why we are ignore changes in other comprehensive income and take it as it is. Whatever you have as of now, that will continue. Treasury stock, treasury stock is when you buy back shares from the market. So when you buy it back, goes into treasury stock. So we are assuming no change in shares, that is no particular new issue, no buyback. So it also remains constant. Retained earnings would come in later. Non-controlling interest. Retained earnings also depend on dividends. So until and unless you have dividends forecast, you cannot forecast your retained earnings. So non-controlling interest, just as we had kept it as constant in P&L, we have costed at we have taken it as constant here as well. So this total is your balance, total shareholders equity, and when you take total liabilities and shareholder equity, it will give you these numbers. And then if you check for balance, it will not be balanced. Why? Because cash is not there. Certain items are not there. But once you have put in all those items, then it should balance. So which means balance sheet will not balance until and unless you have made cash flow statement. Balance sheet will not complete until and unless you make cash flow statement. So in balance sheet, key item left are is property, plant and equipment, which we will do in next class. And once we have done it, then we will move on to cash flow statement. So there are three basic forecasts which need to be made: income statement forecast, balance sheet forecast, and cash flow forecast. Income statement is done. In balance sheet, certain items would be left, like for example, cash number would be left until and unless we have made cash flow statement. Once we have made cash flow statement, then balance sheet should balance. And most of the time when you are making a model, it wouldn't balance. Why? Maybe there you have missed something in P&L, or you have added something in P&L which you haven't accounted for in cash flow. So in order to balance it, you will need to make adjustments in your cash flow statement, or you will need to go back and check why is it not balancing, and then balance it. So that's how you will go about it.
What about retained earnings you haven't forecasted?
Yeah, retained earnings would be forecasted based on dividend. What is retained earning? Retained earning is opening retained earning plus net income minus dividend. So you know net income, you know opening retained earnings, but you do not know dividend. So you will only be able to forecast it once you know dividend. And how will you forecast dividend? You will forecast dividend based on the available when you forecast your cash flow statement. So in there you will forecast your
Will you use the payout
dividends.
ratio?
We will use payout ratio. We will or we will look at the company's ability to generate cash, company's capex requirement, and all that. So generally for companies like PNG or these, they maintain a specific payout ratio, or they have a target payout ratio that they aim to achieve. So their dividends can be easily forecasted. But then again, there are other things to look at as well, like capex, operating cash flow. If a company is not generating operating cash flow, then it will not be able to pay dividend. If it is having huge capex and not taking any loan, then it will be cutting down on dividends. So that's how those are the factors that you need to see when you are analyzing the future dividend payments. But that would be done in cash flow statement. So for now, let's stop here.
So will you be telling us how to extract what will be the future need of, how will we finance future capex expenditure?
Yes, so for future capex expenditure, we will be building in making the fixed asset schedule. In that schedule, we will be forecasting future asset based on the capex requirement. Generally, for a company like this, which is a mature company, generally capex requirement is the same as depreciation. So you either take capex and depreciation as same, or you take capex as a bit higher, or only a bit higher compared to depreciation. That's how you forecast capex. Secondly, you look at the historical capex to sales ratios, that how much was the capex for a specific amount of sales. That is second thing that you look at. Third thing is that you look at the capacity utilization. So generally these companies like Procter & Gamble, you wouldn't find any capacity utilization issues. So as there are no capacity utilization issues, that means there is no significant capex expected in addition to depreciation. So depreciation would be covered through capex, but in addition to that, there is no significant capex for at least next 4 to 5 years. Otherwise, if there is a capex plan, if company has told that there is a capex plan which it is, or it is told that it is already operating at full utilization and it cannot increase production beyond that, then obviously you will need to add up capex. So capex would depend on all these assumptions that we will discuss.
So what about how will we finance that? You're taking the loan constant over there, but what about?
Yes. So when we draw capex, or when you forecast future capex, then based on that capex you would decide whether that capex can be financed through operating cash flows or not. So for example, if I am saying depreciation would be my capex, the amount I depreciate will be used as capex. That means for this I do not need any additional money. Why? Because depreciation in itself is a charge which I have incorporated in P&L. So which means I do not need any additional money. Cash that I am saving from depreciation. So depreciation is a charge which I have recorded. I have recorded $100, for example, charge on my P&L as depreciation. But I haven't actually paid this $100 to anyone, which means this $100 stays with me. So where will I use? I will use this $100 in capex. So as long as capex and depreciation are same, then you do not need a loan. If capex is higher than depreciation, you still check for sources. Is your operating cash flow significant enough or large enough, or free cash flow large enough to finance that? If yes, then go on. If not, then obviously your loan will be required. That is one thing to look at it. Another thing is that whenever company makes big capex, like for example expansion capex or something very significant, then it usually tells you, it usually finances it based on the debt to equity ratio. So if it is a debt intensive company, then it will borrow debt in that particular proportion to finance that
So
capex.
you're assuming that the debt to equity ratio stays same.
Yes, so if you are assuming any change in debt to equity ratio, then you will have to change the loan figure as well. So that can change. So for a mature company, it does not generally change. Otherwise, if company has told you that this is the ideal debt to equity ratio, or this is the target debt to equity ratio, and you think that debt to equity ratio will change, then you will account for it in your calculation. But nevertheless, as we will be performing valuation on free cash flow to firm, in free cash flow to firm method, even if there are debt to equity ratio changes, that wouldn't impact your FCFF much. Why? Because you are calculating the free cash flow to overall firm. If equity becomes lower, debt becomes higher, still cash flow to firm remains same. One has increased, one has decreased. So in FCFF approach, it wouldn't really or much be valuation wouldn't much be impacted even if I change the debt a bit. Why? Because I will be calculating the overall cash flow to firm and then subtracting that from it. However, if you are using FCFE and there are substantial changes or there are changes in capital structure, then that wouldn't give you a fair value. So any other questions on it?